Hey everybody, it's Paul here with Perry, and we are going to try something new. We're thinking about doing this as a monthly series. It's going to be Perry and Paul's Coffee and Cash Flow. So I'm going to let Perry introduce himself to my subscribers in case they don't know who he is.
Hey, Paul. I think this is going to be exciting. It'd be nice to actually talk to somebody on a monthly basis.
Yeah.
So yeah, I think this coffee and cash flow is going to be a good idea. Um, anyway, so my name's Perry. I have a channel on YouTube called the Perry's PIIverse, PIIverse. So Perry's PIIverse. It's ironic because my channel started in July of this year, and Paul started in July of this year. I think, Paul, what was it? You came like 2 days after me.
Yeah, you launched your video. You beat me by 2 days.
Yeah, 2 days.
Yeah, I
Yeah,
started mine on July 18th. That was our first video, anyways, and I think
you're
his
right.
was on the 16th.
Mine was on the 16th. Yeah. So I really see there's a lot of passive income investor influencers on the YouTube channels, but I really have a strong affinity with you, Paul, because it seems like everything we're doing is like the two amigos. In
Yeah.
Blossom, we're about the same number of followers. In YouTube, we started it at the same time. And we've had some nice chats when we went to the Toronto tour together, which was a really enjoyable time. But anyways, so yeah, I'm an influencer, passive income investing. My strategies are my video more focuses on passive income strategy. So you're going to see Mr. Nerdy Professor Perry talk about spreadsheets and PowerPoint presentations. When you're watching my videos, it's almost like you're going to school. Get ready for a lot of long-winded videos from me. I know a lot of people say, Perry, you talk too much. I do. I agree. So that's me. I'm on Blossom as well as Paul is. Everyone, I'm sure Paul's members know about that. We're both on Blossom, but we both have YouTube channels. And I'll leave it now to you, Paul, to introduce yourself to my viewers.
Thanks, Perry. Yeah. So for anybody who's subscribed to Perry and doesn't know me, my name's Paul. This is my channel, Better Call Paul. Luckily, one of the Blossom followers recommended that title, or sorry, that the name for the channel. Uh, my channel's a little bit different than Perry's. I focus on some case studies that I'm doing, sharing my journey, but also trying to prove. Well, I mean, Perry's living off of his portfolio, so he's proof that it works. But I wanted to prove that I could take a tax-free savings account with 50 plus $1,000, start withdrawing 1,000 a month, and have that portfolio survive as opposed to go to zero. And the plan was to do this before I was retired. And then, of course, September 1st, I lost my job. So it was.
Yeah, I was just going to bring that up. Is like you might want to bring it up with my viewers that don't know this, but you were sort of forced into your income strategy earlier than you thought.
Yeah, well, and the thing is, when I started as a DIY investor in 2020,
Mhm.
I was what, 46, 47 at the time, but I knew that I had to start then, otherwise I would be in big trouble because the company I worked for, I didn't have a pension. So, by the time if I wanted to retire at 50 or 55, I knew I had to kind of like take it into my own hands and take control of it. So
Yeah,
that's
and
that's
it's
when I
like,
that's when I fired my financial advisor.
and that's funny because it's almost like somebody up above was looking out for you, telling you better start now, 5 years from now, because I know something you don't know,
Yeah.
and you're going to be losing your job, and so
Yeah.
you need some income. It's almost like someone was looking out for you.
Yeah,
So
it's unfortunately, Perry, is pretty sad that there's a
yeah,
lot of Canadians in the same situation where
yeah,
they're either with a bank advisor or they're with investors group. They have their money invested in mutual funds. They think they're doing the right thing, but they're
right,
actually underperforming the market by a lot.
right. And again, I know we're talking early in advance on this one, but again, it's if somebody says, "Well, geez, I'm not the normal person." This is the normal Canadian, and I'm going to turn around and say, because I do have a lot of American viewers on my channel. This is not just a Canadian issue. This is an American issue. I've actually been talking to one of my YouTube channel followers that's in Germany, saying it's very much an issue in Europe as well. So many citizens do not look far enough in advance or feel intimidated by investing and finance, that they sort of just say, again, I don't know what to do, so I just go to my closest big bank and I just give them monthly contributions from my employment income. And I hope when I'm close to retiring or at retirement, I'm going to go to him or her and say, okay, I've given you all my money. Now make me retire. And they're like, well, you might not have earned enough, right? So I agree. It was good that you had that inspiration 5 years ago, because can you imagine if you didn't and you got laid off this, in September, and you didn't have that?
I would have been in big trouble for sure.
Yeah.
Well, honestly, when they told me that I was getting laid off, I was actually happy.
Yeah. Isn't that funny? As opposed to dreading it, you're like, okay, no problem.
No, I was happy because I was commuting 2.5 hours a day, right, which was killing me, and it wasn't worth it. So I was almost happy when they laid me off. The only disappointing part is I worked with that company for over 20 years, and they want to offer you as little as they can in terms of severance. Instead of giving you what you deserve, they try to keep it for themselves, which is sad. So
it is. Yeah.
Loyalty means nothing.
Well, and that's what people need to go. And again, this is beyond passive income investing. People have to learn in their careers that it's every man for themselves. Yeah. Your employer doesn't owe you anything. And if you're in your job and you have you're working, in a job, you need to have the mindset is you two are working together, employer and employee, as in a mutually agreed benefits.
Right.
The point when one side or the other decides it's not enough for me and I want to move on, you got to turn around and say, look, that's business. For the same reason as if you got a better paying job somewhere else, I don't think the employer is sitting there saying, oh, well, you owe me. At the end of the day, everyone that's employed should know that you're employed and your employer employs as long as you both are being benefited from it.
Yeah.
As soon as one doesn't, they don't. So for us talking in this topic, the point would be is you as the employee need to find out, you got to make sure you're prepared for it in case they call end of the contract as opposed to you. And do you have the financial wherewithal that basically won't stop paying your mortgage payments and stuff like that? And that's why this passive income investing has really become, a game changer. A game changer again for DIY investors that haven't seen it yet. The benefits are huge, and you attest to it on a perfect example of that.
Yeah, once your monthly income from your investments gets to the point where it surpasses the amount of money you can make it work, all of a sudden you realize, now I'm okay. If I lose my job, I will survive, right?
Yeah.
It might not be ideal, but it'll be okay,
Exactly, because there's a point at which, and we'll talk about there's parts of strategy because we're going to talk about it in some of our questions, but there's a point at which your investments are generating enough to pay your bills, but you also want to have buffering, right? You want to make sure that your income coming in from your investments is more than what you need on any given month, because we're going to talk about it. There's those times when the markets go down and all boats go down when the ocean drains, right? That's not just income. It's not just growth. So you got to be ready that on good times, you better have more money than you need.
Yeah.
And you better be ready for it, because when the ocean starts draining, all boats are going down.
Yeah.
And is your boat tall enough that it can survive that sink? Right.
That's right.
Right.
Yeah.
Yeah. And on my side, just to give you, because people, you talked about your side, I started basically in 2023. I was basically a shotgun. I was doing what you were doing even 5 years ago. I was putting all my money into a big bank, mutual funds. I was always in the back of my mind not happy with the returns. Like 4%, 8%, 7%, 10%, then minus 30%. Like literally on average, on average about 4 to 6% yield or ROI. So I kept on doing it, but I'm 62. I retired 2 years ago in 2023. But in 2022, I finally said, you know what? I got to do something different. And that's when I decided I'm going to start in researching my own DIY investing. And I think the same story I've heard 1,000 times from others. And it's funny, we all go the same way. I want to have something that generates more income. So we all went out there, DIY. We looked for all our dividend stocks that could basically generate a yield for us that we could live off of. Yep. And of course, as we know, most of them only do like 4%, 6%. if you're lucky, you'll get 7% on some of the more aggressive
Yeah.
dividend stocks. And that's when in February of 2023, I was watching TV and my business news network was there, and Hamilton popped up an HMAX commercial. And that commercial changed my entire future. It was, because I was like, I'm struggling trying to get 6%, and there's an ETF out there using these things called covered calls that generates 13%. Too good to be true. I went through the whole month and a half of too good to be true. But I researched it, and I was convinced after a month and a half that this isn't too good to be true. This is something that can be changed.
Yeah.
So from February, when I first found it out, to November, I basically transitioned all my investments, all my RIFs, all my LIF, all my TFSAs. And I was so convinced by October of that year, that was the month actually when I retired, was October, that of course you're asked for your pension options. I did have a pension. And I was so convinced, I basically commuted my pension and put my pension into the passive income.
Wow.
So when I say I'm all in, I'm all in.
Yeah, that's the funny thing, Perry. I get some people message me on Blossom asking me, so, okay, you have your income portfolio, but you must have a growth portfolio, right? Like you got another $400,000 or $500,000. No, I don't. I wish I did. Honestly, I wish I did. I wish I had $500,000 sitting in XEQT along with the portfolio I have, but I don't.
No, and that's the funny part, because people turn around and say that, but I mean, they don't turn around and say that. But when they watch my videos, they know what I'm talking about.
Yeah.
But my portfolio right now, I started in November of 2023 at $1.28 million.
Yeah.
And again, people say that's a lot of money, Perry, you're rich. No, it's not. Like if anyone is 55, 60 years old, you add your company pension, and then you add all the RRSP contributions you did your entire life, where you were trying to get tax deductions in order to do that. And of course, my RRSPs kept building up. You put those all together, 1.2 million is I won't say it's average, but for somebody that had a job their entire career and they had a pension, you're generally about $1 to $1.5 million, or you should be around that number. So I started at that number. I am now 100%. I retired in October of 2023. I have not taken, no money comes to me in any other form other than CPP. My CPP is collected about $700, $800. The rest is all money coming from my portfolio. And I actually earn more money by far. I was actually talking to a YouTuber yesterday. I earn 2 times more money in my pension, in my new passive income investing portfolio than when I was working. So it's a game changer for me. So
Question for you: Why did you take your CPP at such a young age?
Okay, so there's a formula, and if you actually, and this is actually the bank that actually gave me the model for it. You don't take your CPP early unless you can assure that your investments generate a minimum of 7% ROI per year. Because if you have a 5-year window times 7, you're basically assured like 36%. Like I think it's 7 times 5, 35%. I think that's the number. So basically, she said, unless your investments can generate more than 7%, you should really hold your CPP until its maximum, because after 5 years, you're assured that 35% because you get less and less penalty each time. Well, my yield is 38%.
Right.
So I turned around and said, I could use that money for investments better than I could use it just having it. Now, in hindsight, I should have actually held the CPP. And again, not because I needed the money. It's actually the other way around. I actually should have not taken the CPP because I didn't need the CPP. Right. So why didn't I should have just left it alone. And at age 65, I would have actually got the maximum CPP, because I'm not actually using the CPP contribution or payments to actually invest. So
I think the maximum's at 70. I think you can post
it's 70.
70, right?
Right. Yeah. Because I know they say something again. By the way, I should say this in our video right now. We didn't say it at the very beginning. Paul and I are not investment experts. We're not certified. We're not tax experts. So I know we forgot to say that at the beginning, but please take everything we say as entertainment and education only. We are not here to tell anybody what to do. if you guys have your own advice, take advice from a trained expert or do your own research. So we should have said that in advance, but
Yeah.
yeah,
I
we're just
don't
two
think,
hacks that like investing.
I don't think I've ever mentioned Perry, but I dropped my phone. I almost went that route in my 20s of trying to become a financial planner.
Yeah.
I was talking to a guy. I was working with a guy from a company. I don't know if you've heard of them. They're called Primerica,
No, I've never heard that come.
right?
No.
And basically, what their philosophy at the time was to try to get people not to buy whole life insurance, which was
Right.
very expensive, right?
Yes.
And provided very little insurance, right? So
Yeah.
instead of spending like $400 or $500 a month on your whole life insurance,
Yeah.
spend like $50 a month and buy term insurance,
Term insurance. Yeah.
and then take the $450 you're saving and put it into investments,
Right.
right? But
Right.
it was all, of course, back then it was all mutual funds.
Right. Right.
And I think
But that's all you had back then. So.
I think he might have been the guy who gave me a copy of The Wealthy Barber, which was a fantastic
really?
book. Yeah.
Yeah.
But I guess me being very, very conservative at the time, I didn't like the idea of not having a job that paid you an income, right? It's
Right.
all commission based.
Commission based, yeah. It's which is risky, right?
Yeah.
Especially when you're young, it's risky, right?
Yeah. So I didn't take that,
Yeah.
but I did consider it for a while.
Yeah.
And I think I learned a little bit about compound interest and dollar cost averaging. Some concepts like that I learned about at that time.
Right.
Yeah, but no, we're not financial advisors. I love Mike from Health and Wealth. He's like, I'm just some dummy on YouTube. You shouldn't be listening to me.
Yeah, don't listen to me unless you want to be entertained.
Yeah. But I do think, Perry, to be honest, I've been watching Adriano for 5 years now. And even though he's not a financial advisor, I was able to take a lot of what he was teaching and use it in my own life. And I've made mistakes along the way. I've done things I shouldn't have done. I lost money here and there. But overall, I've done really well. And I think it proves that this system works.
Well, and that's the thing we need to, like, again, we say it because we want to cover our butts, but the other thing is we want people to know, do not take our advice as a certified expert.
Right.
But the one thing we do offer is street smarts. We tell you what it's like to be on the street. Your advisor that you go to the office with and listen to gives you all this smoke up your bum, telling you all these kind of things. And, you could retire and so or whatever. We're telling you what we actually are experiencing. I don't know, but I know you the same way as me. You and I both on our YouTube channels, in our Blossom community, we are as open and as transparent, almost to the fault. We are transparent. So you get what we get. You can see into our life running this strategy and what the good and the bad is. People say, well, Perry, you don't give me enough bad. Because I haven't run into anything bad. Like,
I've posted on Blossom before, maybe even on Adriano's Facebook, because people are always saying, you only post the good. So I've done times where I've posted about investments I had that like literally went to zero, like investments that got delisted. You know what I mean?
I had those.
or investments that like Innovalis, it's a REIT, right? I think they had property in Germany and France, all buildings. But when the rates went up and the war started in the Ukraine, it crashed hard. So my it was like $9 a share I was buying it at. It was paying a fantastic monthly dividend. It went down to less than $1 a share. Right.
I had that basically the same thing. I had as a teenager, I'll say I was never an investor. Most of the time I just went to the bank and here's your money. But I was interested even at 17, 18 years old. I remember going to the Royal Bank teller back in the 70s and buying a penny stock, some resource stock. I don't even remember what it was. Long since gone. And basically you had to buy the shares. Like you basically put the order in. 4 or 5 days later, I actually went and picked up my shares.
Wow.
I wish I actually had them. They're somewhere here. It's like they're worthless because the company doesn't exist. But you actually had to buy shares. I lost all that money. My mom gave me $4,000. I remember there. I feel sorry that she did it.
Honestly,
I lost her money too.
I'm so afraid now of penny stocks that I've actually lost more money because my son, his friends at university told him to buy this gold stock. And when they told him to buy it, it was around 70 cents. He finally jumped in when it was about 86 cents. He bought 1,000 shares. and this week it hit $4.80.
Yeah.
So, but I honestly, I didn't want to jinx him. I'm like, you know what? If I buy this stock, it's
It'll
going
go
to
down.
go down and you're going to lose money. So
Yeah.
I didn't buy it, but good for him. He's up like 350% on that one stock. You know,
Yeah, and I've got that same story. Like, if anyone watches on my channel, especially my new, like this week, I actually released my new PIIverse membership program
yeah,
for members that wanted to pay money to get more services that I don't normally give. One of them is they can look at my snowball analytics. They can see my entire portfolio. But I've even said it several times. 10 to 11% of my entire portfolio. I'm an income investor. Absolutely. My
yeah,
primary goal is to generate income. But I have 10% allocated for pure growth, high torque, high risk, scratch the itch of investing type of thing.
yeah,
And I have two that are big losers, not big. There's one that's doing okay.
yeah.
There's one an absolute loser. He's down at right now 5 cents a share. He was actually down to 2.5 cents a share.
Wow.
At 3 cents a share, I bought another 60,000 shares. So that was a whopping, what, $3,000? It's
Yeah.
like, but I'm hoping that's going to be a future
turnaround.
torque stock.
Yeah.
And then my third one is the one I talk about on Blossom all the time, which is Athabasca.
Athabasca, yeah.
My Athabasca oil, I'm shocked not more people are doing it. And again, I'm not trying to convince anyone to buy these things, but I got in 2023. I learned about Athabasca oil at $2.18. It's almost on a monthly basis. It breaks new modern day highs this week. Just Friday, yesterday, it set a new one at $7.40. So I've been doing really good on that one, and it scratches my itch. I love doing swing trading and stuff like that with that one.
There's another Canadian company in the oil sector. Okay, and the ticker will come to me. I can't think of it at the moment, but back when I started investing in 2020, I was reading posts on online from Motley Fool. Right?
Yep.
I don't know.
They're very good at doing it.
Everybody's familiar with Motley Fool. After a while, it seems like a lot of their posts are repetitive, but anyways, it basically said buy this one stock at like 49 or 50 cents. And when oil recovers, it will go with the whole market, right? So I bought it and it hit like 99 cents.
Yeah.
And it kept kind of going up a penny, down a penny. And finally I decided, all right, I made like 100% on my investment. I'm going to sell it. Just move on to something else.
Yeah.
And then like 6 months or a year later, it was at like $4 a share.
Yeah. And that's funny. Somebody actually said it in the Blossom community. They said it was one of those sort of like proverbs of investing. It says, I either sell too early or buy too late.
Yeah.
Like it's always not one of those things, right?
Yeah, that's the other thing about being an income investor. For the most part, you can buy a lot of these ETFs. Like I've had HYLD since it launched, right? You can buy it, hold it, and I have sold it in the past, some shares, and I've bought some back, but I've always held it. Whereas with some of these other stocks, it's like, you know, I don't know. Should I sell? Should I not? I bought, what's the big one in Canada? What's that?
Suncor. Is it an oil one?
It's oil, yeah.
Suncor is the biggie.
No, it's not Suncor.
Chevron.
It's one of the ones where their cost per barrel is like $30. Like they are really efficient, okay? I bought them when the market tanked at $19.
Oh, yeah.
Again, it hit about 30, I think $30. And it was sitting between 29 and 30 for a while, but paying like 5%. Like the distribution of the dividend was nothing, right? Every quarterly. And I'm like, you know what? I don't have that many shares. I'm going to sell it, put the money into DFN or something that Adriana was talking about.
Yeah.
Sure enough, of course, as soon as I sell it, a year later, it broke $100.
Yeah. Right? I know which one I think it's the Novus. But I went through the same thing in 2023.
It's
before I learned about
Natural Resources.
Yeah, that Canadian Natural Resources.
Yeah,
that's the other one. Yeah, that's the one you're talking about.
Yeah,
that guy's a rock star right now. So,
but the thing is that see Perry, I'm willing to admit that I don't know enough about these things, right? I didn't know that it was such a good stock. I shouldn't sell it at $30 because it was going to go to $100.
Well, and that's exactly what happened in 2023 or 2022 when I was trying to find dividend stocks. I bought into Suncor. And of course, as soon as I bought Suncor in the mid 40s, it dropped down to $28. I'm like, oh my God, what am I doing here? This is ridiculous. Well, So eventually it did. I waited almost a year for it to crawl its way back up and said, okay, I'm just getting out of this thing.
Yeah.
Right. Sure enough, now I can't remember what it is, but it's definitely much higher. It's in the
I,
60s and 70s. I can't remember
I
the number,
think
but
I picked it up around 22, 23 when the market
yeah,
crashed.
yeah,
And then eventually I got out of it. And yeah, I was up, I think it was up around 50 or kind of goes up and down. But
yeah,
anyways, I feel
yeah.
happier owning ENCL. I'm good with that.
Well, and that's exactly it. Now, and this is what we were talking about. Now that you move into the sector of moving from growth mindset to an income mindset,
Yeah.
you actually look at investments different. If I like the Canadian oil sector, which people should love,
Yeah.
because honestly, even though oil is very volatile, like someone could burp the wrong way in the geopolitical climate, and all of a sudden oil drops $2.
Yeah.
And of course, all again, sinking seas sinks all boats. Of course, all the oil stocks go down. My Athabasca included just drops like 50 cents, 30 cents because the oil goes down. But right now, in the long term, the Canadian oil sector is really good because it has some of the cheapest long reserve oil in
Nice.
the world. And a lot of people are starting to move and see that there's opportunities there. The other thing, and sorry, I know we were talking about income investing, but with income investing, you can now say, I want a piece of that Canadian oil sector,
Yeah.
but I want income coming to me while I'm waiting for it
Yeah.
to grow. Now, in the growth stock, you were waiting for it to grow and maybe also get some dividends. As an income investor, you want the income. And oh, by the way, if it does go up, then ENCL will go up with it. And
Yeah.
so, yeah, it literally, you can have your cake and eat it. You get income while it's sitting there. We talked about trading boxes. ENC has been as high as 21, I think, and it's been down into 17 range. I never lose a second of sleep with
No.
ENCL. It has a trading box.
Yeah.
It pays me a very rock solid distribution
Yeah.
every month. And I don't care if it drops to 18 or 1750 or then goes back up to 20. The NAV, and this people say, well, Perry, you say you don't care about NAV. And they take it out of context. I don't care. It doesn't keep me up at night when we had like this week where we had the markets drop, the biggest drop it's had since the spring.
Yeah.
And people are like, oh my God, what's going on? It's like, no, I don't see this as a problem. I know at the end of the day, they'll still generate income and I can go on buying sprees when that happens. So we look at it in a different view when you're an income investor, because a bad market day is a good buying day for us.
Yeah,
So,
exactly. And I like playing with the NCL. It's one of the ones I've posted on Blossom for since I started. And,
yeah,
when it was up around $20, $21, I started selling off shares.
yeah,
Right. And then when it dropped back down again, I started buying them back.
yeah,
And then recently, about a month ago, it hit like 1950, 1945. That
yeah,
was, and I actually timed it within a few cents. I sold 281 shares.
yeah,
And then a week ago, I was buying them back again for like 1775.
exactly. So you could
So
even swing trade with it.
yeah,
So,
yeah.
yeah,
I make sure I keep I think 30 days or whatever it is because it's in my tax-free savings account. So
right.
once I sell it, I won't buy it back again for at least 30 days.
Okay.
Yeah.
Yeah. And you can do that only if you can't loss harvest. Is what
No, no,
right?
no, no,
Yeah. Yeah.
no. Not in
So
your
I mean,
TFC.
you could do it on gains. Like you could do it on gains, right?
Yeah.
So yeah. But I mean, that's the thing. Sorry, and I apologize because I'm sure you have the same thing. We have a lot of American viewers and a lot of worldwide viewers. Both Paul and I are Canadians, so we bear with us that we talk a lot about Canadian
Yeah.
covered call ETFs. I think people may not know those people that are new to covered call ETFs and the passive income. Even though the first covered call ETF was invented in 2007 by, I think it was Invesco, it really didn't even really hit the markets until BMO had a few of them in 2011.
Yeah.
And even then it didn't take off. They were still there as these niche things. I don't know why anyone would buy them. But basically, it was the Canadian markets that basically exploded it around 2019. I don't remember when Harvest and that showed up.
Yeah.
From then on, all the explosions on these new, I'll call them modern day covered call ETFs, exploded in Canada.
Yeah.
And it was the American market that basically said, we want a piece of that action too. I think that I'm speaking on my own terms, but I'm seeing there like there's something money to be made there. And they started doing so. There's not as many covered call ETFs out in the market that people think. I think the last one I saw a report on in summer was there's no more than around 400. 200 of them,
Call?
more than 200 of them are Canadian.
Wow.
And the American ones, I believe, when I saw the report, was 119. So back then it was under 400 covered call ETFs. I think they grow so quickly now. I think we're over 400.
Did
just,
you ever
just so
own,
people know, it's not that big a market as people think it.
For the Americans, did you ever own QYLD, or what did they have? RYLD, XYLD?
Nope. I had RYLD.
Yeah.
I did. I never had QYLD, but I had R, and I didn't last long. I had it for a while, and it just seemed like an underperformer.
I think probably just before you retired and got into income investing, QYLD was like a rock star, right? That was what all American YouTubers and even Canadians were like making videos about and collecting and so on. Yeah. But now it's like a dinosaur, right?
Yeah, nobody talks about it.
No, right? There's so many better and more efficient. That's the thing. Like, people talk about income investing and covered call ETFs as if there's only one type, right? It's not like that. It's like anything else, right? There are automakers that make great cars, and then there's automakers that make cars that are kind of crappy, right?
And what happens? Supply and demand, and it happens in the investment community too, especially for ETF makers. It's different if you're a company and you're selling stock. At the end of the day, your company is your stock. That's the way you are. You can reinvent the company, but your stock is tied to the company.
Yeah.
With ETFs are a human created investment product.
Yeah.
They create the product. And the nice thing about ETFs and mutual funds too, but mutual funds, in my opinion, are like the way of the dodo themselves. ETFs are manufactured products for investment. And what happens when you've got multiple competitors that are creating product?
Yeah.
They're always competitive. They're always trying to leapfrog each other. They're always trying to say, what does the consumer want? I'm going to give them what they haven't had. Like our Roundhill, when they moved to zero DTE, or the ones where they went to weekly pays, and now they're going to actually daily pay.
Come on.
The nice thing about ETFs in general, covered call ETFs have actually really grabbed into it, is there's generations of improvements in these instruments, right? Like, and I really don't like the covered call naysayers that say all covered calls will go to zero and all these arguments of that. And they all talk about, look at QYLD. You're forgetting that's like saying, look at the Model T Ford. Yeah. It's like, you're talking about an older generation of covered call ETFs that people have said, you know what, that's not working well. Let's come up with new ETFs that have like put spreads or have call spreads or basically can protect ours, or we're not going to go that aggressive. And so when you're looking at the covered call ETF market, you're looking at a generational improvement every month almost. You're seeing improvements of it. So when you're doing things like rebalancing, I don't rebalance just because I want to rebalance. I rebalance because maybe I've got some of that old generation covered call ETFs that are, they were good in their time. They were very front loaded on great dividends. And now they're sort of being long in the tooth, and that strategy is not working that well.
Yeah.
So when you do rebalancing, one of the reasons you're rebalancing, among several reasons, is you want to move to the new generation of ETFs that have put better protections in, or better offerings, offering leverage now that they've never offered before. So investors got to know, don't listen to the FUD that's out there that, well, look at QYLD. Well, you're looking at somebody that says, look at my Model T Ford, and saying all cars are Model T Fords. No, that's an old generation, and things are improving, and you got to fine tune and improve your portfolio as the new generations of ETFs show up.
Yeah. And the longer that they're out, the more information we have, right? The more that we can see which ones, like HDIV, is doing really well,
Right.
And
I agree. And again, again, for those investors that listen to the FUD that says that something that was around 3 years ago, look at how bad it is. Yeah. And the other thing that, please, anybody that tells you that covered call ETFs are not long-term investments, but stocks are. Nothing is a long-term investment. It's as good for you in your portfolio until it does not serve you a purpose.
That's right.
And, like somebody brought it up to me when I did a video to compare HOOY to HOD, right? In that head-to-head battle, showing that during consumption, an income portfolio will always be the growth portfolio. And the naysayers is like, Could will be around, but where's Hui going to be in 10 or 15 years or 30 years? I'm going, do you invest in a stock that you know you're going to hold for 30 years? I sure as heck don't.
Yeah.
I invest in a stock or a mutual fund or investment that's going to stay in my portfolio as long as I think it provides a value.
Yeah.
If I believed what they were saying, then basically he says, where's Enron? Where's Lehman Brothers? Where's BlackBerry? Where is Northern Telecom?
Yeah.
Imagine those people that put all their money towards those growth stocks and said, that's long term. If I'm going to hold this one for 30 years. Well, sadly, a lot of them lost their retirement because they followed that strategy because they were so static and not dynamic in their investment strategies, right?
Yeah. Mike Perry, I don't know if you ever owned Algonquin Power.
I did.
I remember
during the heydays.
I remember when I first started investing, and I found out about Algonquin Power. I think it might have been one of the few. Did it pay monthly or maybe it paid quarterly? But basically, I was trying to talk to my friends and my kids and explaining that you're always going to need power, like electricity, right? You're always going to need to have your lights on. People are never going to stop using it. So this is one of those safe utility stocks.
Yeah,
right?
I remember
Now, because I'm an income investor who's chasing yield. When it was at about $19 a share and I was in the green, I decided to sell it and probably put my money into UMax or something else that holds utilities but with a higher distribution. And sure enough, what happened? As soon as interest rates went up, everybody realized that Algonquin Power was over borrowing. Right,
way over, way over,
and they had fluctuating or floating variable rate interests, right? And what they do, they ended up cutting their dividend, and their share price tanked, right? So it's,
I just called it up. It happened around October of 2022. It was one of the stocks because remember I told you I got into doing my own DIY. I got into Algonquin Power there as well. I bought it at 9. It popped up to 10. It was down to 7. And I was like, oh, but it paid nice dividends. And then on that one day, the markets came out that said they can't afford the leverage that they were doing. And it dropped down to under $10. And it's been in the 10 almost down to the $6 range. Ever since. So it happens to growth stocks as much as it happens to income stocks.
That's right. There is no guarantees. But now this brings me, Perry, to a post that I was reading on Blossom a couple of days ago where somebody was talking about MSTE and ULTY. Right? To me, no different than Algonquin Power because it went from $19. Actually, I think it was around $21, went all the way down to $6, cut their dividend, right? People would have lost a lot of money. But who would put 100% of their portfolio into Algonquin Power or MSTE or ULTY?
Or any investment.
If you're doing that, then
you're a gambler.
Whether you're an income investor or a growth investor, you need to really sit down and learn more about investing because if you're that under diversified, you're in big trouble, right?
Yeah, exactly.
Unless you happen to pick the winner. You know what I mean? And
you look like a hero when you pick the winner.
Right.
Unfortunately, then things like, now again, MSTE and MSTY or any of the MSXXXs that are based on MSTR. Go look at it. That's more volatile MSTE and them because they're doing leverage. But at the end of the day, they're following their underlying. Look at MSTR. For the growth investors that turned around and said, you should have bought the underlying. You would have been, well, go look at MSTR from if you would have bought it in June to now. You would have been down there too. The benefit about MST and MSTY and all the ULTYs, again, I'm not promoting any of them right now, is the fact that while it's going down, it's still paying dividends. MSTR is going down, and all you're seeing as a growth investor is an erosion of your NAV.
I have MSTY, I have MSTY, I have MSTE, I have ULTY in my portfolio. But do I look like I'm worried? Am I panicking? Right? Have I messaged you, Perry, saying what should I do? Should I sell the loss? No. But I get those messages. People asking me, what should I do with my MSTE? Don't do anything. Hold it. Right.
And the biggest problem we have with the people asking these questions, first of all, those that are still they've taken their foot and put it into the income space,
Yeah.
as well as they still have their foot strongly entrenched in the growth space. They're still thinking like a growth investor because they're still looking at the NAV saying, well, I can't sell, I'm going to sell it at a loss. Well, one of the strategies of passive income investing is buy and hold.
Yeah.
So you've lost nothing if the ETF is down 30, 40, 50%. I've got CONY. It's down 72%.
Yeah.
I don't stay up at night worrying if CONY is going to ever recover. I don't worry about it. I'll tell you why. Because it was, again, when I bought it, it was very expensive. It was in the 20s and 30s. So I've got a huge NAV loss on it. But the one thing that I've gotten ever since then, it was very front loaded with distributions where I was making $7,000 a month at times on it. Yeah. So honestly, I'll tell you right now, it's called house. We nickname it as house money, but it's had all of its investments paid back in distributions.
Yeah.
I don't care if CONY goes down and reverse splits and keeps paying down a trickling, let's say $300 a month. It's $300 a month that CONY doesn't owe me anything. Like selling it off and realizing the loss, what does that give me? It doesn't give me anything. I can take the money out. You know, let's say I invested 100,000. I'm now only into say 16,000. I can take the 16,000 out, but remember, your yield is based on its current price. So for me to go and take the $16,000 out and find something that will generate more yield, it means I have to find another covered call ETF that's generating 90% yield.
Right.
So at the end of the day, I'm sort of in a trap. I can't sell it because if I sell it, I'm going to have to move down to something with much lower yield because most of them don't have that yield. So just deal with it. It's a stream that's sort of getting smaller and smaller, an income stream. I'll call it an income stream in your bucket.
Yeah.
And yeah, it used to be a river, then it turned into a creek. Now it's down to a stream.
Yeah.
But at the end of the day, it's still paying, and it's paid me back all my distributions.
Right.
So I don't worry that CONY's down 72%. Like you, I have Alty, and I do have MSTE, and I have MSTE. The one thing that you and I haven't said yet in this video is the big difference is those people that go all in.
Right.
Don't go all in. Learn investment strategy.
Yeah.
And again, if you're one person that doesn't really understand what you're investing in 100%, or you don't know the future of a more higher risk investment, you moderate the target weight of how much you're going to put in your portfolio.
Yeah.
And that's what I say. I have MSTE. It's 1.7% of my portfolio. If it falls off the face of the earth, I lose 1.7%. I know it's not going to fall off the face of the earth because as long as MSTR's around, they'll be around. Yeah. They may not pay much distributions, but they'll be around.
Yeah, that's why, I was sitting at a little over 40 positions, right? Because if one of them, one of the smaller positions, like you said, goes to zero, it's really not going to hurt me that much. Yeah. Right. It's really not. So,
and you know what? It lets you, again, if you watch my, and I know you have it too, in my YouTube channel, I have one video. It's basically my PIIverse strategy document. It's my entire video on how I do my strategy.
Yeah.
Diversification is one of the #1 pillars of my strategy because you know what? If you're diversified, and I know there's some people that says you only need 6 or 7 in there. I'm not arguing with that. You don't. The less ETFs or the investments you have in your portfolio, the more conservative they better be, or the more broad spectrum they better be. I know Adriano has maybe, I don't know the number, 8 or 10 of them. But if you look at what he holds index-based, all-in-one, conservative ones. He doesn't worry about any of them going too far. He knows they're not going to be, there's no single, I know he has one single stock, MSTE, but there's very few single stocks. His base is bread and butter, are index-based, safe investments. Yeah. They'll pay every day. So how much you diversify is based on how much risk you want to take. If you're looking at MSTE, you better be diversifying a lot.
Yeah.
I feel sorry for the people that actually not only believed all the stuff on, falling in love with the social media about one ETF. And again, this is nothing against covered call ETFs. Any investment. Oh, I should have bought that meme stock, or I should have bought whatever. Anyone that buys just because the social media is talking about it, and then the double mistakes, then leveraging and taking margins out and buying them on them. again, mistake 1 and mistake 2.
Yeah.
And those 2 mistakes together make mistake 5, because that's like magnifying the problem, right? So, yeah.
All right, Perry, we got to get back on track here.
Yeah,
So,
I know. Sorry.
Did you want to hit me up with we got some questions for each other. Do you want to hit me up with the first question?
Yes. Yeah. So the one question I do want to hit, and this one's important. I brought it up before when we did the Pioneer one, right? I want to ask you, because you're expert and more than me on this. I've got a lot of American investors that are following my channel. They're saying, Perry, I love your strategy, but you talk about your base investments and you talk about your juicing or yield enhancing ones.
Yep.
All of my base covered calls are Canadian ones. HYLD, HDIV, HHIS, ENCL, all of them. Literally, if you look at my portfolio, all the ones that are conservative, stable NAV, stable distribution is my base. And my strategy when I talk to everybody is, my strategy is you have to have a base of 50%, and then you have to have another 50% that's your yield generators, the ones that are going after them.
Yeah.
Well, the Americans are saying, I love your strategy, but what do I buy if I'm an American? I can't easily get access to them with the exchange rates and the withholding taxes. Give me some alternatives in America that can give me that kind of stable cover call ETF, like the HYLDs that only pay like 12, 13, 15%.
Yeah.
But you know their NAV's going up, and you know that their distributions generally are actually level or always going up. Give us, to the audience, some of your examples of what you might think I would recommend to them.
Sure. So these are pretty popular, Perry. You may have heard of some of them, but one of the real popular ones that people talk about is NEOS, right? So
Okay.
NEOS has probably more than 2, but the 2 that I know best would be SPY-I, right, and QQQI. So with those 2, obviously you're getting your S&P 500 exposure in SPY-I, and you're getting your NASDAQ exposure from the QQQI one.
Right, which that helps for our viewers. It's part of the good base of cover call ETFs 100%. Because they're index based. They're broad spectrum. So that definitely hits one of the targets for a base ETF.
Those ones I think would be like you said, Adriano, right? For example, I think he might have sold one of them, but he used to have QQCL and USCL, right?
Right.
I think he sold USCL because he now has, is it S-Day?
Oh, okay. I didn't know he sold that one.
Yeah.
Now those are Canadian ones. So would you see that the NEOS are equivalent to those?
Well, QQCL is holding the NASDAQ, right? Am I wrong?
Yes, that's right.
I believe it is, right? And,
right.
and USCL is, I don't know if it
more the S&P-ish.
Yeah, more the S&P-ish, right? So then if you if you want to look at something other than NEOS, you have your Goldman Sachs. I don't know if you heard of GPIC and GPIX.
Okay.
Right? So they have their version as well. One of them is the NASDAQ, one is the S&P 500, and that one's they've done really well.
Okay, so let's backtrack. So we'll talk about the Goldman Sachs one, but how about with the NEOS? What kind of return are they getting? Like, do you know, like just rough thumb in the air, are they getting like 10% or are they getting 20%? Like, what kind of yields are they getting?
Yeah, I think if I'm not wrong, I'm not mistaken, I think SPY-I, you're probably looking around 10%, maybe 9, 10, 11%. And then
I knew they were on the lower teens, right?
Yeah, and then QQQI is probably a little bit higher, right? Than the
because it's more aggressive.
Yeah,
it's more volatile. Yeah.
Okay. And the Goldman Sachs ones, I'm not even sure what they're getting, but I think if you look at like GPIX or GPIC over the course of a year, their share price is up quite a bit. So
which is
right. So you're getting some growth as well as some income, and they don't have that NAV erosion that people are always talking about, which is nice as well. If your share price goes up a little bit and you're getting the income at the same time.
And that's where I talk about the 50% of my portfolio strategy that's base.
Yeah.
They basically are they're a conservative yielder. So I consider that to be 10 to 25% in that range. And as you said, they're also stable in NAV. And when I say stable in NAV, as an income investor, a growing NAV is not that much of interest to me. It's a bonus to me.
Yeah.
If it can maintain a stable NAV, that's great. If you get a growth part of it, usually you will see that in the 10 percenters, 15 percenters, because they actually, the way they're doing their cover call strategy is a lot less aggressive. They allow a lot more room for the non-contract portion of the underlying to grow.
Yeah.
So again, I'm not looking for a core holding that will actually grow, but it's a nice bonus because it basically, you know, when you got something like an HDIV or NEOS or Goldman Sachs, if it's going up, at least you know you paid more than you paid less than what it's worth.
Sure.
And you know that it's paying the yields I want, and it's staying above the NAV for those people that are concerned about NAV erosion. Though I just wanted to cover that up on there.
And then, as we were talking about last year, there was a new player in the States, the company Tap Alpha, right?
Yeah.
They came out with their version of SPY-I, but it's T-SPY.
Yeah.
The difference, if I'm not wrong, is that it's using a zero DTE strategy.
Okay.
Right. So it's a little bit more dynamic. And if I'm not wrong, again, I'm pretty sure their distribution is more around 13-14%.
Which is nice. Yeah.
Which is nice. Okay. And just this year in September, they came out with their second ETF, which is TDAC. Right. So now they have their SPY version and their NASDAQ version. And I'm pretty sure that one's around 17%. That's the one. I already have T-SPY. Now I'm buying TDAC.
Okay.
So that's their first two. We'll have to wait and see if they come out with anything new. What I always tell people, Perry, is all three of these options are probably more or less equal.
They're equal because they're all doing the exact same index. It's just how they run the cover call strategy over it, right?
So you probably don't need to buy all six. You could probably pick two. Right? Or maybe four at the most. Maybe
pick two of the SPYs and two of the NASDAQs.
Yeah.
And the reason I believe in that for diversification, because some people say, "Why are you doing this? You got so much overlay on your underlying." Again, what I say to people is that it's more than just your underlying overlap.
Yeah.
It's also the fact that what happens if something happens to NEOS?
That's right.
What happens if something happens to Tap Alpha?
Yeah.
You want your investments to be diversified not only in your underlyings, but you got to remember both of them run their overlay strategy, their cover call strategy differently.
Yeah.
And so you're doing it for diversification of that strategy. You're also doing it for diversification of ETF managers if something went wrong with it. Remember, this is your portfolio.
That's right.
Again, they're not going to come and apologize to you, Paul, to say, sorry, we went out of business. What can we do?
Yeah.
Boo-hoo.
Yeah,
it's up to you to protect your portfolio.
Just like in Canada, we diversify. We own Hamilton ETFs. We own Evolve. We own Harvest. So that's what I would do. If I was in the States, I would probably pick one or two out of those three and buy. And then if you want something a little bit more, right, there are some funds that offer Target 20. And
I was going to ask you about the Target 20s. Isn't that from YieldMax? Is now coming up with some new ones? Or?
So the ones that I own are from Defiance, right? Okay. Because when Defiance first came out with their high yield, their ultra high yield funds.
Yeah, I got them. IWMY, QQQY, yeah.
Right? They didn't do great in the beginning.
No.
So they realized that there are people who wanted a more stable. Right? So they came out with SPY-T and QQQT. I get them confused. SPY-T, T-SPY. But so Defiance came out with two, maybe. I usually don't buy the Russell one, but I have I don't know if there is a Russell one. But anyways, if you want a Target 20, which means like a 20% yield,
right?
Defiance has those two.
And that's you bring up a good point because I've seen more and more doing targeted, right? Yeah. So for my American viewers and your American viewers, look for anything where they're doing target yield.
Yeah.
Like where they're turning around and saying, look, we're not gonna go for, because they called YieldMax for a reason. They were going for maximum yield.
Right.
And Defiance sort of followed the same kind of strategy. We're going to give you ultra yield. Well, of course, the erosion just hammered them on those ones. They've learned their lessons because I've got still IWMY and QQY, and they've actually been relatively stable and earning still 30-40% yield.
That's right.
I still wouldn't call them a core. Absolutely wouldn't. But if you look for anything that has basically a capped yield or a target yield, you're going to get a more safer, more conservative one because they're not being as aggressive on their yield. So you're going to likely get them to be a better fit. Even if you're doing single stocks and stuff, you're going to get them as a better fit for a core holding as opposed to I'll call it an income chasing one. Right.
Yeah. So Yield Max did come out with their target 12.
That's it. I knew they came out with something.
I know they have one called Biggie, right? The ticker's BIGY.
Yeah.
I
Yeah.
don't know if
Not
there's
to be mixed up with Harvard's biggie.
right.
So,
I don't know if there's more than one,
right.
but you really just need one. But anyway,
Right.
so if you're looking for something to add to your
Yeah.
portfolio other than the T spies and spy T's
Right.
and that, there is
Yeah.
that target 12, and now they're coming out with a target 25.
Okay. Yeah.
Right. So if I was living in the States, what I would do is I would buy a little bit of the target 25, you know what I
Yeah.
mean? Maybe $100 a month or something,
Yeah.
see how it goes.
Right.
Right.
Just
Don't put in $20,000.
and
And
this is what we call dip your toe. If you
yeah,
don't, again, I call it dip your toe in the market.
yeah,
And I've seen a lot of other influencers do the same thing. And again, education for the new investors. If there's an ETF that you really fall in love with, or you say, I think there's some potential with this one, start off small.
yeah,
Do a 0.5% portfolio holding. Just put in, if you put in like $100 or
yeah,
$1,000, and it's amazing. Just one holding is enough for you to watch it more carefully.
yeah,
And if you really like it, then increase your target weight and say, you know what, this guy's been delivering. I think I'm going to increase it. Don't go all in because you've heard something and say, I'm going to do 3% holding weight on it just because I've heard the market. So very good point on dip your toe.
yeah. So then if you really want to, and there's so many funds, like we can't. You said there's what over 100 in the States.
Over 100. When I saw the one report in summer, it was 119 and growing fast.
Yeah. So,
Yeah.
I mean, obviously, I don't know them all off by heart, but one of the ones that I do hold, if you want higher than 25, now you want to go up maybe. So you've got your foundation, right? We've already bought our SPY-I and QQQI or whatever. So you got your foundation, but now you
Yeah.
want to juice your income. You want to try to get a little bit higher.
Yeah.
I've bought AIPI. And
Okay.
I used to have FEPI, but I don't have it anymore. But I think FEPI was targeting around 25% and
Yeah.
AIPI was 35%.
Okay.
So I ended up selling my FEPI and putting it all into AIPI.
And you bring up a good point. If you want to move, like I consider a core to be anything under 25%.
Yeah.
It's not a hard number. Generally, if you're under 25%, you're going to get a cover call that generally is very NAV stable.
Yeah.
It might go up and down a little bit, but it's one you'll never lose sleep at night if you're under 25%. Anything over 25% and moving up the scale, you're going to get more volatile, more waves and distribution and NAV instability.
Yeah.
So you are right. If you do want to go into that area where you're switching over from core into the early entry juicers or income juicers, a good suggestion I would say for both our viewers is look at the all-in-ones, look at the index ones.
Yeah.
They're going to give you more juice. Like for example, there's ones from the weekly pays from Roundhill.
Yeah.
They do have WPay, which has become very popular.
That was good. That was going to be the next one I was going to suggest, right? Because Roundhill is very popular, and there's also the original Roundhills was what QDTE,
and RD. I hold them too. Yeah,
right. They came out with the first 0DTE, I think, and were they paying weekly from the start, or they're just paying weekly?
They were the ones that started weekly, and that's where Defiance had to catch up to them.
Yeah.
So you're right. You've got the 0DTE ones from
Roundhill,
QDTE, RDTE, and then they put out these things called week pays.
Yeah.
Now, for anybody that is watching us, I fell for the same trap too. They are not covered calls.
Right.
They are what's called swap agreements.
Except for MSTW.
Except for MSTW. For some reason, Roundhill decided that one we're going to do cover calls. Nobody can explain why they did this.
Right.
Unless you have MSTW, all of them are swap agreements. They are very aggressive. They basically have they have leverage with them. They're very aggressive. They can go up and down. They're very volatile because they're not covered calls. They're not capped in either direction, so they can go all over the place. But the nice thing with WPay, it's all of their week pays together, and you're getting a nice yield, and you've muted the volatility a little because you're holding all of them. So that's a good one to actually consider. It's a WPay, but don't consider it a core. Consider it an income juicer.
Yeah, those are the ones that I like, right? Like WPay. I even still own YMax from Yield Max, even though it's probably underperformed a little bit. But actually, I think if you look at the numbers, had you held it from the beginning, people forget you have to add back the distributions.
Right.
Right. If you're just looking at the share price, it looks like a train wreck. But if you add back the distributions, I don't think it's as bad as you think. Right. But anyway, so the all-in-ones. Now here's a question, Perry. Do you
index and all-in-ones are two safe? Anything that's index or all-in-one, like for example, YieldMax also has YMax.
Yeah.
Which again, the yield maxes are, again, they're sort of becoming last generation. People are starting to move away from them because there's NAV erosion in some of their single stocks and stuff. But YMax is sort of holds all of them. Again, I'm not a fan. I've never held YMax myself, but if you sort of want more of that juicy stuff, but you don't want to hold the single stocks, YMax is an option to look at. I think don't hold it as a core.
The mistake that they're making, the mistake that YieldMax is making with YMax is they need to get rid of the dogs, right?
Yeah. Take the dogs out of it.
Yeah. They should have in their prospectus that, you know what, they can, like a Murney. I think it's Murney that's down around a dog.
Well, Murney's been a dog since day one. Yeah.
Yeah. Like, you know what I mean? Some of those, like if it's hurting the fund, why not get rid of it?
Yeah, get rid of it. Yeah, take it out.
Yeah.
Make YMax healthier.
Yeah.
Like call it YMax top 10 or YMax top 15.
Yeah.
Leave this one in place, but give one for the people that says, I don't want the dogs. I'm willing to invest in the top 10, the ones that are holding their own, right? And that way, I think more people would more head towards them. But who listens to Paul and Perry, right? So.
All right.
Okay, that's a good advice. I like that one. I'm hoping my American and international viewers find this interesting. Again, follow the idea that we're looking at a core set. They're going to give you lower yield, but they're more conservative. They'll preserve your NAV. They're the ones that you can go to sleep at night, even with a market correction. They'll go down. Everyone's going to go down, but they won't collapse to nothing. They'll still pay their distributions. Their distributions might drop a little, if at all, because they tend to like holding their distributions level. But those are the ones you should really build as a core in your portfolio.
That's right. Yeah. Build your base. And I like what I do, Perry, is the reason why I don't get bothered by buying something like Alti is because I don't buy it with money from my pocket, like my bank account, right?
It's coming out of my reinvestments.
Yeah, I take some dividends, which of course that's still your money. You don't want to lose your money. But for me, I feel better about using some dividends to buy something like Alti.
That's right, because you've already capitalized it. It's capitalized gains that you could decide that you want to take some risk on it, right?
Yeah, that's right.
The point with risk, and this is again what I talk about, build yourself a proper income strategy. Because if you have a strategy that understands how you're going to invest, understanding, in my opinion, setting target weights is one of the most critical things in income investing, as it is with any kind of investing. If you're going to take a risk and dip your toe into something, your target weight should be very small.
Yeah.
If you're getting more comfortable, it could get a little bit bigger. If you're getting very comfortable about it, you could set it to a more, let's say, mainstream target weight. But don't, like I have Alti. Alti is like less than 2% of my portfolio.
Yeah.
Again, it's right now a real dog. It's a real dog. But it doesn't keep me up at night because my strategy says I knew that was a risk going into it. So I wasn't going to do it. It's the people that go into it and say, oh, Alti, it's going to make me $1 million in two months. I'm going to go all into it.
Yeah.
You can take chances with it because they're educated risk mitigation chances.
Yeah.
Because you captured it, you held it into a small bucket, and it's good. All
right, Perry, we're going to go on to question number 2 here.
Yeah.
So this one's a little bit different. It's not necessarily about investing. It's about being an influencer or a YouTube creator.
Yeah.
So Perry, your channel exploded. Okay, you were monetized very fast in about 6 weeks, right?
Yeah.
Now you're almost at 10,000 subs, right?
Yeah.
Seems too good to be true. But what are some of the downsides or difficulties you've experienced running your channel?
I think the biggest one, which really bubbles up to me, is, and I don't think people that have ever run a YouTube channel understand this. It's the amount of time it takes up out of your life.
Yeah.
Like I never had a bucket list item that when Perry retires, I'm going to become a YouTube channel creator and I'm going to make hundreds and thousands of dollars on my YouTube channel. I got pulled into it because everyone was asking me about my portfolio spreadsheet. and I wasn't giving it to. So I said, okay, I'll make a video, and I'm just going to show you on my video. I'm going to do a grand tour of it. That's when I released it in July 16th, and it took off so fast that people were like, I want to see another one. I said, I want to see another one. And so I got really rooked into becoming a YouTube influencer. So the first thing I don't like is the fact, and it's just growing pains. I got to learn how to govern my time and figure out a better way of actually governing my time. So that would be my first mistake. The other thing I found is not, let's say, one of the darker sides of being let's say an exploding influencer, like again, going up to 10,000 in only 3 months, especially on a topic that seems very polarizing, like our income, high yielding income versus growth, is the amount of trolls that I get.
Yes.
People that basically, they don't even want to do covered call ETFs. They don't even want to do income investing, but they just basically wake up in the morning saying, I need to go and do some hate on something I don't like, as opposed to, like, if you don't like covered call ETFs, if you don't like income investing, then go out and have a coffee, go out and do a walk, go and do something productive. Like, why they spend their time trolling on me is beyond me. And again, I know you get it. I know Adriano and several of the other influencers get it. The more popular you get, the more you're attracting trolls. I don't like it. It really is a negative side, because the channel could be very productive, and it is. I generally have now come to the point that if I get anybody with any kind of negative attitude, and again, I don't find challenging questions to be trolling.
Right.
If somebody comes to me and says, Perry, I'm not really believing your strategy, but how would you deal with this? And they ask me as a question of which I can then answer and respond to them. And they'll go, thank you very much. It's not what I was looking for, but thank you for responding. That's positive criticism.
That's right.
It's the ones that says, you're going to go down to zero. You've just blown all your money. I've finally learned, don't respond to them. I've finally had to turn around and say, you know what? You're not here to do anything but to be a troll. So I've just had to start deleting them. Again, I used to hold them out there because I wanted to be transparent so that people could say, look, there's negative sides to this and negative opinions. I wanted to see it. But that's not negative opinions. That's basically trolling. So that would be my other one. How about you?
I'd like, as obviously when we release a video, we want people to watch the video. You know what I mean? You don't want to release a video and have 1 or 2 views or whatever. Right. And we want people to engage in comments, right? We want to have a conversation. I'm literally all day on my phone, looking at my YouTube studio, trying to reply to comments.
Right.
Even just to say thank you to people for watching, or appreciate their comment, or thank you for having positive feedback. And there are people who obviously disagree with what we're doing and question it, and it's not for them. And if you can relay that respectfully, then I'm okay with that.
Do it.
If the first thing in your comment is, this clown has no clue what he's doing and he's going to lose all his money in a bear market, like, that's not nice. You know what I mean?
Well, not only is it not nice, do individuals like this actually think that what he's saying is going to get any traction?
Yeah.
Because everyone's going to look at it and says, oh yeah, there's a troll. Here's another troll. So the individuals that do such things like that, they're quickly spotted by the general community in the channel that says, oh boy, he's not, first of all, I'm not going to take anything he says with any credibility. So they're not even getting any traction. They're basically making themselves look silly. So I agree with you. So
anyways.
Okay.
Definitely time consuming. That's for sure.
Yeah. And that's why I said we both have to start learning this stuff. So I think another question I have for you, and ask for us to talk, is, of course, people have always been saying this about, the naysayers about covered call strategies and high yield income strategies using covered calls has been, you know what? They're all looking good now. They're looking really good now, but wait till that first bear market that hits, and it's going to be at 20% down. They're just going to collapse to nothing. They're going to erode to nothing. And again, they can say what they said. I know I've got facts that are already showing that there's evidence that prove otherwise. Paul, Adriano was around during the pandemic and showed how they actually recovered there. I saw the April one, which was one of the steepest declines in modern history for the account for markets. I could show you my results. You could show you yours. we're doing better than we've ever done before. So we know they recovered. So I'm not worried about that. And I know that distributions will go down, but they'll go back up. But what do you have to say when somebody says, you know what, I'm willing to listen, but what are you going to do? What are you going to do, Paul? How are you getting ready for that bear market? What are you going to do to be ready for that bear market? Or should I basically start selling things? So what's your answers to that?
Okay, so, and this is something I've been thinking about recently, partially because everybody talks about a crash coming, partially because the market's been at all-time highs, and it can't stay like that forever. And also, it's funny, but when those people post comments on your videos saying that you're gonna go to zero, you start thinking about it like, are they right? Maybe I shouldn't be buying Alti. Maybe I should be buying something else, right?
Right.
So, for me personally, I will never sell out of my investments. Like I will never go to cash, right? That's just something I don't do. I know people that are 50% cash, have hundreds of thousands of dollars in cash, and you talk to them and they have formulas. Well, when the S&P 500 drops 20%, I'm going to deploy $20,000. Then I'm going to do this, and then I'm going to do that, and then I talk to them like, so how did it go? Well, the S&P dropped down to 7. It dropped down 17%, but it never quite got to 20. So I didn't invest, and they're kind of like still sitting on cash. So I don't do that. But what I am doing right now personally is I'm focusing on my foundation, like my base, because I was going pretty tech heavy for a while, and buying things like MSTE, CNYE, HHIS. To get to the point where I was making over 10,000 a month. Right. But now that I'm at the point where I'm making more than double my working income,
right,
I'm trying to focus on utilities. So I like Utes. I had UMAX, but I swapped it out for Utes from Evolve.
Yeah.
I'm adding to CONY. So instead of just buying, like, look at Biggie pays a lot more than CONY.
Right.
But Biggie's just more tech exposure. So I'm trying to.
You're looking for the more stable of the cores.
That's right. So I'm buying more CONY to get, because what I believe is that once people start selling off their tech stocks, they're going to move the money into more stable blue chip companies, right?
And defensive stocks.
And sometimes when the American economy tanks like that, it seems like the Canadian one all of a sudden excels, right? So I'm putting more money into ENCL, buying more oil stocks.
Right.
And the other thing I'm doing is I'm trying to sell off some of my single stock ETFs. I'll never sell all of them off. I like some of them, but just to reduce some of the ones, if I can sell off like NVHE, right? I sold it, I think it's, say, for argument's sake, $14 a share.
Yeah.
And it pays 22 cents. And I was able to buy more HHIS at $13 and it pays 26 cents.
Right.
And it holds NVHE. So I still have it, right?
But that's the one I did right away. As soon as HHIS came out, I did the thing and said, what single stocks from Harvest am I going to buy in addition to HHIS? I was already sold. I'm going to get HHIS. I basically used HHIS's yield. And I said, anyone that pays less than that I hold, I'm selling. I sold NVHE and LLHE immediately because they were already in HHIS. And so I was already covered that. And I only bought the ones that are above it so that it would add more yield.
See, but I don't know about you, but at one point, NVHE was way down below what I paid for it.
LLHE also had some major dives too in the early days.
So basically I waited until all of a sudden NVHE skyrocketed again. NVIDIA, it's got its swings. So it all of a sudden became popular again. And I was able to sell it above HHIS, which is what I wanted to do.
Perfect. So then you can move it into HHS.
I did that. And then in my other account, I sold it and moved it into Biggie.
Right.
So I'm getting rid of some of those. I'm definitely getting rid of some of my yield max. Not all of my yield max, but I'm getting rid of some of it. So I'm basically trying to bulletproof my portfolio a little bit. But I mean, just in the last week, I'm way down from my all-time highs. Like my portfolio size.
People say we don't do transparency. I'm going to tell you right now. Was it Thursday when the markets went for a nosedive? I was down $52,000.
I believe it.
My NAV. I didn't lose $52,000.
Right.
My NAV dropped $52,000.
Yeah.
It came back up like again. I never even NAV is just something I look at as okay, it is what it is. You know, when the April swing happened, the big one on Liberation Day, that one happened.
Yeah.
I was down at like my current NAV is around 1.6 at that time. I was down at 1.2. I was back to my time 2 years ago.
Yeah.
I was at 1.29.
Yeah.
So for people to think that you know, oh yeah, we'll wait till the NAV. But my NAV, I never lost sleep on it. Yeah, I was like sort of wondering, like, is our entire economy collapsing? Like, what's going on? That was my bigger worry.
Yeah.
But I knew that if it was all going down, they're all going to go down. And sure enough, I'm back up. I reached 1.7 million about a month ago. So again, that's why I don't worry about market drops of, you know, 15, 20%. And that's what we're talking about here. People are asking me, so Perry, if there's an impending market doom coming or a big market drop of 15, 20%, what are you doing to get ready for it? And my answer is, I already did it. My strategy is to diversify 35 holdings, of which of those 35 holdings, my core is 50% of those. I basically have a thing called a 3 times expense ratio.
Right.
Basically, at the end of the day, my portfolio's job is to pay my bills every month and make sure it absolutely will pay my bills every month. Okay. I already know that number's around $8,000 to $10,000. I use 10 as a top max. So my portfolio better be paying out at least 3 times my top expense.
Yeah.
3 times is 30,000. I'm already generating 48,000. So what is my strategy? My strategy is I'm so diversified that, you know, when the markets go down 20%, I'm going to see my distributions drop 20% as well, or maybe even 30%. Let's say 30%. So 48 goes down to, let's say 32, whatever it is. Let's say it's even 25. It's going to stay there. I'm not losing anything. I'm not selling, like you said, I'm not selling any of my assets.
Yeah.
I'm still above what my expenses are. And I'm using that extra buffer space that was my protection for bad markets.
Yeah.
To say I can reinvest while they're the good markets because I'm getting all that money on that protection zone, that buffer zone. When the markets are really bad, I'll just go down to a level where I just won't be able to reinvest as much because the distributions went down low enough that I can only reinvest a little bit. But just as you said, I'm going to start investing in more basic stocks, like more to my cores. So if I had to make any change, it's maybe the change of what I'm reinvesting in. That's
Right.
really what I'm actually talking about, right?
Yeah. Perry, do you have any idea how long we've been going for?
Does it say it? I don't know if it says that here. So.
I don't see it.
Yeah. Well, we'll go on forever. Remember, you and I both did a great interview with Gil, and Gil just goes on forever. So
I know, right? Okay.
Okay.
All right. So my second question to you was very similar. So I think we've already answered that question. I was focusing on, you know, if there was going to be an AI bubble crash, what would you do to prepare for it? We've already kind of talked about that. So I'm going to skip on to the third question I had for you. So the third question is, what is the biggest mistake you see income investors making?
Okay. That's a really good one. And I've actually saw it really magnifies itself over the last week or two when you've been seeing, you know, the MSTYs and the ULTYs, and it's like the talk of the town now in the Blossom community. By the way, for anybody that doesn't know what Blossom is, both Paul and I on both our channels, this video will have a link to it. Click either of our links and you should sign up to Blossom if you don't know what Blossom is. Great channel. He's even got it on his shirt there. You can see his.
I consider it like the Facebook, you know, the Facebook version for financial investing, right?
For DIY investors. Yeah,
I agree. Right?
It's
a
social, for DIY investors.
Yeah, social app for people who, like you said, you don't really have too many people to talk about investing with, you know, in your friend group or whatever. So you go on Blossom, read people's posts, post yourself, ask questions.
Yeah.
And
no question is dumb. Like I've had some questions right from my sister joined back in July, didn't even know what an ETF was. So no question is dumb in Blossom. People will ask the question, say, you know, what's an ETF? And you won't get insults. You'll get people saying, well, here's what an ETF is. So it's a great place especially for newbies. people that are just starting their thing, but it's just as good for advanced people because I still learn every day on Blossom new things about tax strategies or, I didn't know this happens with this. So yeah, definitely join.
And really, it doesn't matter if whatever you're investing into, there's somebody on there that's their niche. Like there are day traders who talk about day trading, swing traders, people who are into, well, the one guy, Anthony, he's into, what is it? Space. Like, you know what I mean? Like that's
somebody for everything,
right? That's his niche, is those kind of companies, right? So like whether you're into precious metals, crypto, Bitcoin, doesn't matter.
Name it.
Right?
It's got it.
Yeah. Anyway.
Yeah. So that was a plug for Blossom, and we both believe in it. That's actually how we became YouTube influencers, because of Blossom, right?
You know, Perry, I was thinking about it. It seems like we did really well starting a YouTube channel, where, I got my 1,000 subscribers within, I think, 10 days, and then I hit 2,000 within 13 days. And you look at some people like Adriano, where it might have taken him a lot longer, but you got to take into account, I spent, I think, maybe a year and a half, almost 2 years posting on Blossom to kind of build up a bit of a following.
Yeah.
Right.
Yeah. We both came to YouTube as influencers, not expecting to be influencers, YouTubers, let's call that.
Yeah.
We both came in with over 5,000 members in Blossom. So we had that little boost because the Blossom members that followed us actually helped us kickstart our channel.
Yeah, I think it definitely helped, right? But if it wasn't for the year and a half that I put in making those posts and working on that, I don't think
you would be doing the same thing right now, where you'd have 100 views and
and if honestly, if we hadn't done that, then guys like Mo and Ari and Marcos, they wouldn't have wanted to interview us, right? If we hadn't. So I feel like we did do the legwork, we just didn't do it on YouTube.
Yeah, we did the pre-work in Blossom. So again, unexpectedly.
And even, I don't know about you, but even before Blossom, I was on Adriano's Facebook group. He's got a passive income investing Facebook group. I was on that one posting before I started on Blossom, right?
Yeah, exactly.
So it's been quite a journey.
It has. So getting back to it, the reason I wanted to talk about Blossom, because some people didn't know what Blossom. But on Blossom over the last week, with the markets going down, we had one of our biggest collapses in the market just on Thursday since the spring. And you're getting a lot of the people that are starting to expose the weaknesses of their strategy.
Yeah.
And that's what I say. I don't want to say weakness of the investment, weakness of their strategy. One of the ones that really I see is the biggest mistake that new investors, and maybe not even new investors that are on any strategy, growth or income, is that they don't have a strategy. Yeah. They literally chase social media news and stuff like that. So are the people that said for the last 6 months they've been seeing on Blossom how everyone's jumping on the MSTY. So instead of turning around and doing their own critical thinking, their own work, saying, okay, I could see MSTY being good. It generates a lot of great income. It is considered high volatility. Maybe I'll only put 3% of my holding weight in it. They go all in, or they go, I'm gonna become rich really quickly, and it's gonna solve all my financial problems by going into MSTY. 40% of my portfolio, Alty, 1%, 100% of my portfolio in Alty.
Or borrowing money to do it.
Or the worst one is the people that are borrowing money to do it on something that is absolutely not a conservative, like borrowing money to go into GIC as well. It's a loser anyways, because you're going to pay more than that. But going into something like an HYLD or an HDIV and saying, okay, I'm going to borrow money for something that's very conservative. So maybe. Again, I don't promote anybody doing margin investing anyways. It's always a risk. Yeah. But to do it in a strategy where you're going after margins on very high risk covered call ETFs, and then doing it not being down to 3% of your holding weight, where if you lose it, you only lose 3%, but doing 20, 30, 40% of your portfolio on margined accounts. Yeah. I feel bad for them. It's got nothing to do with the covered call. I hold MSTY. I hold Alty. But if you have a good strategy, says, no, I'm going to set target weights for every one of my thing. I'm not going to let a MSTY. I'm not going to believe in social media, and I'm going to invest in everything. Everything should be done in moderation and based on how much risk each investment is. Yeah. That the mistake I see, people are not doing that. They should research more on a strategy before they buy their first covered call ETF.
Yeah. And diversification is key, right? We
Yeah.
have to be diversified.
Yeah.
Don't go all in. You know, I understand the allure of it because
Oh yeah.
I bought a lot of MSTE as well, right?
Yeah.
And I understand people see that high distribution. It's going to
Yeah.
increase their monthly income the fastest,
Yeah.
but you have to make sure you still have a base. You know, you got
You
some,
need to believe in the underlying, and everybody says this.
yeah,
Believe in the underlying. If you truly believe in MSTR, then you better know it very well.
yeah.
You better understand it. MSTR is a Bitcoin oriented, extremely high volatile stock. You should never have bought an MST if you don't like high volatility.
The
Because
way I looked
MST
at MSTE when it first came out, was it paying 50 cents or
55,
55?
55 cents. Yeah.
So the
Yeah.
way I looked at it was this.
Yeah.
It's paying 55 cents, which was fantastic. I think it was something ridiculous, like a 45% yield, right?
Yeah.
When it first came
Yeah.
out, maybe
Yeah.
more.
I think it was more. Yeah, but yeah.
The way I looked at it was, if it was paying me 30 cents, would I still buy it?
Yeah.
Right? And the answer was yes, right?
Yeah.
Because NVHE was paying 22 cents,
Yeah.
HHIS was paying 25.
25.
So
Yeah.
if it had been paying 30 cents, I would have still bought it. So
Yeah.
now I'm buying it at 55 cents. If it
Yeah.
cuts its distribution all the way down to 30, I'll still be happy.
Yeah. Because it's still paying more than HHIS was doing.
Yep,
And
right?
again, as long as you buy and hold and you don't sell it,
Yeah,
like the people are panicking. Again, this goes to another mistake. People that panic and say, this is going to, that's it, I'm selling out of it. As soon as you sell out of it, you exit your income stream and you capitalize your loss.
that's right.
That's why income strategies are all called buy and hold. You ride through the low ones. And
Yeah.
basically, like I still got CONY, 72% NAV
I-
erosion. I'm not selling it because at the end of the day, it's still paying an income, and it makes no sense to sell the loss.
Yeah,
Just
about
keep letting it draw a stream.
now. I have heard people talk about losses in the stock market is almost like going to university, right? You pay to go to university to learn. Sometimes in the stock market you lose money, but you learn, and that's
You
the
learn from it.
cost, right?
Yeah.
So a few years ago, I was on Facebook, on Adriano's channel. DFN was tanking. It was probably in 2022, right? The bad year, right? DFN was tanking. For anybody who doesn't know, it's a split corp. I think it's a type of, is it a closed-end fund? I'm not sure. But anyways, it's a split corp. It was tanking. It stopped paying its distributions. And there was one guy on Facebook who kept posting that DFN is cooked, like will never recover. And you know what, Perry? I fell for it.
Yeah.
I fell for it.
Yeah.
I can't remember if I sold 1,000 shares or if it was $1,500 worth, but I realized the loss.
Yeah.
I don't know if I sold my entire position, but I sold like half, thinking I'm just going to get out while I can. And it went down to $3 a share.
Yeah.
Now it's at $7 a share.
Yeah.
Right?
Yeah.
I should have been buying it at $3 a share.
Right.
Right? So be very
That's
careful.
exactly, you nailed it. You nailed it. The point is that especially if you're an income investor, if you're a growth investor, they think differently. You can't think like a growth investor when you're an income investor. First of all, everything you buy, every time you reinvest or contribute and add more holdings, more units of any holding in a covered call ETF, you're compounding and adding more income to your income bucket.
Yeah.
Another stream comes in. Again, if you turn around, like I have my CONY going in, and if CONY used to be a big hose like this, and it's now down to a little hose, it's still generating. It's still putting water in the bucket.
Yeah.
And again, I'm not capitalizing my losses. Like, what's the use in it? Let it reverse split. Let it go down to a little straw. I've already got my money out of it. Like the funny people laugh. It's like, wow, your CONY's down 72% loss in NAV. You know what my ROI on CONY is? 25%.
How much has CONY paid you?
CONY has paid me $95,000.
So what I think people don't realize, and this is where it becomes very difficult to track. Like sometimes people will ask me, well, how much did you make from HYLD? It's very hard for me to tell you that, because if you're like me, you took the $90,000 that CONY paid you, and you put that $90,000 into HHIS, HYLD, blah, blah, blah. And all of those now pay you.
Right.
They all pay you. And then you take the dividends that they pay you and you're buying something else. Now you're buying,
and this is why they
buying CONY, right?
Yeah,
So
you nailed it, Paul.
it's impossible to track how many income streams that CONY created for you.
Yeah.
Right?
Yeah, because everyone uses the simple model that says if you would have reinvested back, what's your ROI? It's the only model you can use.
Yeah.
But at the end of the day, you hit the nail on the head. People say, well, do you dollar cost average? Do you drip? First of all, I don't drip.
Right.
I'm retired. I can't drip because I need the investments to turn into cash so that I can say how much is going into my bank account and how much am I reinvesting. So I can't drip even if I wanted to. Secondly, I don't drip because I like controlling where my reinvestment goes.
Yeah.
So I don't want people say, well, why don't you DCA this because now CONY's down at $6, $5? Because my number one priority on reinvesting and in rebalancing is my target weight.
Yeah.
CONY has hit my target weight. I refuse to reinvest anymore in CONY because my target weight was 4%. I'm at 4%. As much as I could maybe make them deals on it, I don't. I use the money, like you said, and I start reinvesting in the other ones that were underweighted so that they are now popping up. It's like it's compounding income all over the place. So when somebody says, how much have you actually realized from the distributions from CONY? I can only tell you what it would be like if I would have put it back into CONY.
Yeah.
The amount that I might have got because I put some of the CONY into YSPY or I put some into HOW, which is now generating 90, 115% yield. That's not taken into account.
Yeah.
CONY has done its job in generating reinvestable yield that I can actually now generate compounding interest income elsewhere.
Yeah, so, exactly. I always like when HDIF came out, I took dividends from my tax-free savings account and I started buying it.
Yeah.
Right? Until I had about $10,000 worth.
Yeah.
So that's $10,000 worth of income that I made from other ETFs that I put into HDIF. Then HDIF went up. Like I bought it at $8
a share. You gained the NAV on it.
Right? It went from like $8 a share to $10 a share, but it was only paying like an 8% yield. So I sold the whole thing, realized the gain, put it into, say, ENCL, which was at the time paying 21%.
Right.
So you can see how it flows.
Yeah.
And it works because my income keeps going up. It doesn't. We were talking about this. It doesn't always go up month to month. Like there's no way I'm going to make in November what I made in October. Right. But I bet you in 3-4 months from now, I'll be at that level. It'll be the new.
Because what you're looking for is not the month-to-month increment, because every month is a little bit different. They may have bad months, good months on the more volatile ones.
Yeah.
You have sometimes 5-week months versus 4-week months. Sometimes because everything's doing weekly now, some of them fall into the next month, so they don't count that cash. Yeah. But the trend is for it to go up. Yeah. And that's the big one, is the trend goes up, because every time I just reinvested some of my cash on that Thursday market collapse.
Yeah.
I had a lot of reinvestment, excess money sitting. So I bought them. I somewhere in the next month, I'm going to see $900 a month more.
Wow.
Showing up in my income.
Yeah.
It's not going to show up right away, but it'll show up in the next couple of weeks, or next week. It's already going to start bubbling up.
Yeah.
On a monthly $900 or more. Again, so the idea is you're reinvesting. Everyone says, oh, you're just reinvesting to stabilize the NAV. It's a small factor for me. Yeah. I reinvest because I don't need the extra money. I only need the $10,000 a month to live off of. The rest of it is to compound income, so I could do exactly what we talked about earlier, where that 3 times expense moves to 4 times expense, moves to 5 times. When I'm at 5-6 times expense, do I care if the markets collapse 50%?
No.
50% take me from 5x maybe down to 2.5x. I'm still paying my bills. And that's my strategy as an income investor for bad market days.
Yeah.
Right?
And once it drops down a certain amount, it will start to recover.
It will. It's a temporary thing. It'll be until the markets come back up.
It might take a while to recover, but it will start to recover. So your income will start to grow again.
Oh, absolutely. Yeah, you're right. Yeah. So that was the mistakes we talked about.
Yeah, that was it. That's the 3 questions I had.
Okay, I got one more question.
All right.
And then I think we'll call it quits, because people think that they're going to have a podcast marathon here.
Yeah, either that or I'm going to have to get a more comfortable chair.
Yeah, exactly. I'm going to have to go to a lunchtime. So this is my last question, and then we'll sort of call it quits for the day.
Yeah.
you get a lot of people that watch your videos of newbies. I get it all the times, and I'm sure you do too. People that were growth investors or didn't DIY at all, but they were watching YouTubes and they said, wow, can I make $1,000 a month? Like, especially with yours, like I can sustain 1,000, I can sustain 2,000. I love it, Paul. I love it. I don't have a clue about covered call ETFs. I don't have a clue about DIY investing. I've got an RRSP or a TFSA with $50,000. Where do I start? How do I start? Yeah, I've got some ideas, but I'd like to hear your opinion. What do you tell that new investor that has the money, wants to get into your strategy and doesn't know how to start?
Yeah, that's a great question, Perry, and I get that one quite often. People who they're new to income investing, or they're new to investing in general, right, and they're doing a lot of research, but as part of their research, they would like your or my opinion just to see, what do we say? And then, hopefully they'll compare that to other, information that they're gathering, and then they can make their own decision. That's the key point, is you got to make your own decision, because it's your money. But first thing I like to do, Perry, is find out where are they from. If they message me on Blossom, I'll click on their little link to see if they're American or Canadian. Because if they're American and I start telling them about Harvest and Hamilton, they're going to be like, what is he talking about? So I try to figure out where they're from. Assuming they're from Canada, right? Yeah. I also try to get a bit more information in terms of, do they have a pension? What's their situation like? Like, are they desperate for money, or do they have a lot of money, whatever? But what generally I like to try to suggest to people is, again, we've talked about, is start slowly, right? If you're going to put $50,000 into the market, or $100,000 into a market, and I told this to a friend and he didn't listen. He put all 100,000 into tax-free saving, into ETF, into covered call ETFs, and he did it like in 1 week. Okay. Yeah. And what I had told him was, divide it into like 4. Put $25,000 in, right? And see what happens, right? Because if the market goes down, you put in 100 grand and it goes down to 80,000, you're going to be upset. Yeah. Like, you're automatically going to think this is a losing strategy.
Don't bulk buy.
Yeah. But if he had to put in $25,000 and he picked 5 different ETFs, put some in each one, right?
Right.
And then if the market drops while you're still sitting on $75,000, now you can put in another 25, right? And you can dollar
and buy it lower DCA.
Yeah. Now, on the other hand, if the market goes up, you're probably going to be happy because you're making money, right? People like to see the market going up, right? And then you can buy a little bit more.
Right.
And with these covered call ETFs, what worked for me anyways, it was actually DFN that the first high yield one I heard about was, I bought some and I waited a month. And when you see the distribution land in your account, you feel a little more confident, you buy a little bit more. Right. And then 2-3 months in a row, you're getting paid, you start to understand how it works and you feel more confident about it. So start slow, right? Of course, do your research. And sometimes I'll just make a suggestion like, take a look at Evolve, take a look at Bank, take a look at Utes, take a look at now they have Biggie and Canny. Take a look at Hamilton, HYLD, HDIV, so on. So I kind of give them a few tickers.
And now in this video, we talked about the Americans, what they should look at.
Yeah. Right.
Same kind of thing.
Yeah. And if it's an American person, then I'll tell them, if they're from the States, I'll tell them the same thing, take a look at maybe Tap Alpha, Neos, GPIX.
The conservative ones.
Yeah. Right. And, and then if you're going to buy those, but you want a little bit more, maybe you can look at something like CNYE or MSTE as addition. Basically, you have to start slow. Don't jump all in. Don't invest all at once. And
I'm even going to take a step further back than you. Because I've actually had to go through this when I was first starting this, and I had some of my ex-coworkers that are now on Blossom. They watch me now all the time. They were the same way. They heard I was doing this. They're like, I'm intrigued. How do you doing this? The first thing I did is I said, again, at that time, I didn't have YouTube channels. I can now turn around and say, watch my YouTube channels. But but at that time, I said, first thing, I did actually a Zoom conference call with them. I said, I'm going to show you everything I'm doing.
Yeah.
I'm going to show you the basics. I'm going to show you what I'm doing. I'm not telling you to do this at all. I'm just getting your foot in the door to understand what ETFs are versus stocks, to understand how covered calls sort of work, how it generates income, what are the good and the bad, and the stuff like that. Once I got into that, call it that 2-hour interview, which again, I don't have to do anymore. I could just say, people watch my YouTube channel, watch Paul's, watch Adriano's, which is good because I couldn't tell them that before. The next thing I told them to do is, you are so new at this. Do not invest any money. Go and create a Royal Bank practice account or whatever you do. Take $100,000 of practice money and start experimenting with it. You're not going to lose anything. It's all practice phony money.
That's a great idea.
And they did that. They actually went there. I said, because I'm going to tell you right now, I don't want you to lose any money because you followed me.
Yeah.
If you're getting involved in income investing, like any kind of investing, but if you're following me because of what I'm doing, I want to make sure you're doing it because you understand the investments, you understand what you're getting into, and you're getting used to how they operate, the good and the bad.
Yeah.
So the first thing I told them to do, and I did that with my sister as well, because she just got into it in July. Actually, by the way, I'm looking at creating a video to interview her to do exactly this conversation, which is, how did you get started, and have her talk about how she got started. But start with a practice account, play around with it. Same thing you suggested. The first thing I would tell anybody would be is, we just talked about earlier in this interview about the core ETFs, the stable ones, the safe ones, the ones that basically are indexed or all in one, the ones that have like a mixture of growth and conservative yield. Work with them, sit with them. So from practice accounts, set up your first TFSA, because a lot of them have never even set up a direct investing account yet.
Yeah.
Set that up. And then start playing around a little at a time. Like you said, take maybe $1,000 and put it into HDIV, or put another one into HGL, and just watch how it works. Watch how it generates the income. Watch how it comes in as distribution. Look how you're going to say what you're going to do with it. Just get your feet wet. And then as you're I'm getting comfortable with it. And that's exactly what my ex-coworkers did.
Yeah.
They did that. And they finally got to a point where they're convinced on their own right, 6 months later, that they actually, started dissolving their other investments, like rental properties or whatever they had, and said, moved it into that, because they were so convinced on their own that it worked. So I don't want to be the person that says, you got to do this, take all your money from your RIFs and your RSPs and move it in there. You need to believe yourself, and you need to be convinced yourself before you invest. So, and don't, like you said, let's keep it slow. I totally agree. Crawl, walk, run.
Yeah, and it's sometimes it's hard
because it's your money you're going to lose. If you do it too quick, you're going to lose your money, right?
When you're messaging somebody on Blossom or something, I mean, it is hard to provide a lot of detailed information. Right. People just send you a message. But when I'm talking to friends of mine or other people who are interested in this, you also have to explain to them a bit of like the risks, right? There are risks. You know what I mean?
There's risks with every investment.
I was actually on Global X's website when I was doing some research for a video on ENCL.
Yeah.
And in their prospectus, or one of their documents, they have a page, Perry, of risks. Okay. Yeah. And sometimes on my channel, I'll talk about 3 or 4 risks. Yeah. In their document, they had like 40. They listed like 40 potential risks of investing in ENCL. I couldn't believe that they broke it down that much.
That's great.
Yeah.
And that's what people need to do. Like, again, when we get down to that granular advanced level, like you're talking about, don't believe what social media tells you. If you're going to invest in ENCL, go onto the ENCL webpage, read the entire prospectus, understand the risk, understand what it's investing in, understand how its underlying structure is going to work. Invest in it when you fully understand it, not because Paul or Perry told you that they love ENCL and it's one of their darlings.
Yeah.
It should be because they read the risks, they understand what they're getting into, and they have a strategy about it. They know, like, I look at all my 35 covered call ETFs as my babies, as well as my 3 stocks.
Yeah.
Everyone has a personality. I've learned the personality for every one of them. I never worry about ENCL. I've had it for over 2 years. I know it's got a trading box. I always watch it. If it ever dropped into $12, $13 or down to 10, I would wake up.
Yeah.
Because I know the personality for ENCL is never to go below $16, $17. So I would wake up then. But you start learning the personality of every one of your covered call. When you see HDIV going up 20 cents or 10 cents in one direction, that's a typical HDIV. If you see HDIV going up $2 or going down $2, you're like, what's happened?
Yeah.
You know what I mean? So evolve, learn things slowly, pick up a new ETF after researching it yourself and know what its risks are, and then buy into it and then watch it, learn it.
Yeah.
That's why I believe in catalogs of covered call ETFs. I don't like bringing in so many that are like brand new, because I have a catalog. If you joined my catalog, it's going to be one of the 35 that all my accounts are going to use.
Yeah.
So I can say, I can learn it, and I learn it, and I know I safe it around because I understand how it works.
It's taken me a while to do this, Perry, but I think you have to be a bit patient with your buys, right?
Yep.
Not, I guess people call it timing the market, but
Timing the market,
before I would say, okay, I want to have 1,000 shares of HYLD, and I would just start buying it, right?
Yeah, just buy it.
But now I look at what I have, and it's like, okay, I want to build on this position, but my cost is $13. Right now it's at 15. I'm going to wait until that one particular sector or ETF has a bad day or two and drops down, and then I'm going to buy more, as opposed to always increasing your average cost.
And that's the strategy part that new investors should know. Like, don't think you have to say, but I got 100,000. I want this money now. I want to start making $5,000 a month like your daughter's making right now, like whatever that number is.
Yeah.
No. Go at your own pace. Go slow, because it's your money you could lose if you don't do it right. Like the people that are using margins to buy 40% target weight. Believe in target weights. Set target weights up. You need a strategy. If you first build your goal, what are your goals?
Yeah.
What are the strategies behind your investment goals? And how are you going to deal with risk mitigation for good and bad? Think all that through. And again, we've got videos on our channels that help you through those things, so that you could build a strategy and then start putting the Lego blocks into your strategy.
Yeah.
That's based on, okay, well, Perry said I shouldn't have anything more than 5% on any of my holdings. Now, if they believe in that strategy, great. Then don't go buy 20% of something, because your strategy says stay within 5%.
Right.
Good. So a strategy is key.
Yeah, for sure.
Yeah.
You definitely have to have a strategy for the good times, and you have to have a strategy for the bad times, because we all know there's going to be bad times.
Well, and the thing is, a strategy is most valuable during bad times.
That's right. And you will learn most about your portfolio when times are bad.
Yeah, absolutely.
And I was looking at my RBC TFSA for my case study, because it's the middle of the month now. I usually do 2 videos a month. And I'm actually happy that the portfolio balance is down, because for a few months, it was like always going higher and higher and higher. And it was like, this is too good to be true, right? And people are just going to say, well, your portfolio is doing well because it's a bull run or a bull market, right?
Right.
But I'm glad to see that it's actually dropped back down again, because that's real life. You know what I mean?
Right.
This is a real life situation. Now let's see how my portfolio does over the next few months.
Yeah.
You know,
this is going to be the real test.
That's right.
Honestly, I think you and I both believe what generally people are feeling. We're going to be going into some bad times soon. I believe so. You know, with all the instability and the major disruptive changes in the U.S., which when the U.S. hurts, the world hurts.
Yeah.
So I have a feeling we're going to be feeling some bad times coming up in the next while. So this is going to be interesting to see how our portfolio
holds up,
performs in it, right?
But the other thing is, Perry, bad news sells, right? So the media is always pushing some bad news, some story, people overreact. So I wouldn't be surprised if we had another 2 years of bull market, because
it could happen.
It could happen, right? Yeah. That's why I don't put cash.
No, and that's why they get anybody that holds cash, in my opinion. Sorry, that's like, I'm holding cash only because I capitalized a big gain. Otherwise, I don't. Yeah. I normally used to hold less than 20,000 on a $1.67 million account, because to me, cash sitting idle is cash not earning income.
That's right.
Yeah. And again, if you're a growth investor and you're in the consumption phase of your life, then you have to start looking at things like this thing called the cash wedge and stuff like that. Yeah. And the reason they have to do it is because when the markets are bad, let's say for a whole year, and all their stocks have a NAV depression of 20%, they're now worried about selling their stock at much lower prices. So a lot of them, to mitigate that, puts in cash wedges. The problem with a cash wedge is the fact that you've got literally money sitting there almost generating no income. Right. Because it has to sit in very stable accounts. Otherwise, it'll go down with everything else. So they can't do anything more than a money market fund on them. So literally their money for in a year, maybe it's like you said, they're putting their money in and they think the market's going to collapse. What happens if the bull market goes another year or two?
Yeah.
You just had money sitting there 2 years, not generating any wealth.
Have you ever
Yeah.
watched the Dividend guy from Montreal?
Yes, I think so. Yeah.
Yeah. So
Not
he
frequently,
he
but
he talks about having a GIC ladder,
yeah.
right? And he talks about having enough money to survive a 3-year bear market, right?
Yeah.
That's what he's saying is would be about the longest a bear market would last would be about 3 years, right? So
Yeah.
what I'm trying to figure out is, do I need to come up with some kind of a cash wedge, like you said,
Yeah.
for an income portfolio, just in
Yeah.
case things go down far enough and
Yeah.
my monthly distributions go below where I want them to be, where I can't really reinvest, and
Right.
if anyway, so that's what I'm trying to figure out. What kind of a cash wedge should an income investor
Well,
potentially?
and that's where I turn around, and I've had a lot of those debates in my channels. I don't believe in a cash wedge for an income portfolio. Personally, I don't, because at
But
the
here's
end
a
of the
question,
day,
Perry. Here's a question, though.
yeah,
Okay, what if
yeah.
we swapped portfolios? What if you were
Well,
making 10 grand a month instead of
yeah,
40 grand a month?
right,
Then would
right.
you reconsider having a cash wedge?
Well, no, because here would be my strategy on that. Sorry, and we're going to another one, but
Yeah.
I actually have in my strategy. I talk actually one of my videos. I talk about the idea is how much. What is that? What is that 2 times? Like, what should your target yield be?
Yeah.
What is your target yield? If you're a high yield income investor, what should my target yield be? There's where what you're talking about. If you're turning around and saying that your portfolio at say $100,000 or $100,000 is only generating $10,000, and say you need 8,000, and let's say you turn around and say we need a 3 times expenses. So 8 times 3 is what, 24?
Yeah.
My brain's old. 24. So you're saying that you're generating 10,000 and you need 24,000 to feel comfortable. Now you turn around and say, well, but my yield is only 12%.
Yeah.
What does it take in yield to get me up to 24? Oh, I need to have about a 35% yield or a 32% yield. So now you can change your income portfolio to say, okay, I'm going to have to buy a little bit more higher yielders or more income juicers to bring my yield up to that number so that I could basically have a bigger buffer, right?
Yeah.
That would be the countering of doing a cash wedge, is to turn around and bring your income higher. Here's the good part. You've got money now generating excess cash. You only needed 8. You've now got $16,000 in addition to what you need on your 8 that's sitting around doing nothing. Well, guess what you can do? Reinvest it back and start buffering up.
Yeah.
Then you could maybe go down from 35% down to 25%, because that money that was not sitting idle generating you income, let's say a bear market doesn't happen for 2 years. For 2 years, you were able to reinvest that money into CONY, HDIV, HHIS, and start. And now you're bringing that number up. It's called compounding income. And that's why I don't believe personally in a cash wedge. I believe in adjusting your yield and then trying to recycle it. Right.
But I mean, my yield's probably already around 30%. Like if
Okay.
I was at 12%, then yeah, I could do that. But I'm already.
You're right. There's a point at which you can't do it, because if you're already too aggressive, right?
Yeah, take on more risk, right? So
yeah.
But anyway,
and that's where your problem is I think I brought that up in one of my questions where it says, well, yeah, but I'm already at 30%.
Yeah.
Well, now the thing is, well, you shouldn't. Now, in your case, you were laid off, but anyone that's that close to their monthly expenses and is planning to retire may have to think about, it's not time to retire yet. You know, that's that magic number to say, okay, then I've got to wait till I get to 3 times yield, 3 times expenses, or I got to maybe switch to a part-time job so that basically my 8,000 expenses is augmented by CPP and other employment. But you sort of hit the rule saying my income coming into my bank account should be coming about 3 times income. I'm saying 3. It could be 2, it could be 4.
Yeah.
And then you have to make lifestyle changes if you're at that point. I can't go from 35 to 50%. Now it's just crazy. I need to do something else like CPP and reinvestment or
that's the thing. Like if the market really tanked, I can always alter my spending, right? Like I have some fixed expenses, but then I have money that I spend that I don't have to spend, right?
Yeah, discretionary expenses.
Exactly, right? Like I don't have to go out to the keg and spend $100.
Right. And that's where you got to do lifestyle changes.
That's right.
Exactly like that. Like, don't expect that you're going to do an income portfolio and it's going to pay your, there's a magic point where you could do fire or retire.
Right.
If you have not reached, you should do the analysis and research to determine what is that magic point. For me, a portfolio should be at least 3 times expenses so that you can hit the lowest of the low markets, 20% down, and still pay your bills comfortably with that portfolio generating that income.
Yeah.
If you can't do it, you need to turn around and say, is it really time to do FIRE?
Yeah.
Or I'll do FIRE, but I'm going to do FIRE on a part-time job. So my part-time job pays part of that salary. And then the income does the other one until such time as you could wither away and go to full FIRE. That's a lifestyle finance and budgeting decision.
Yep.
The income portfolio can only generate so much income safely or aggressively, but there's a point at which, like you said, you got to cut some of your expenses if you want to retire, or you got to do a part-time job, or you got to wait longer, those kind of things. Those are things you got to make decision after your portfolio does what it does, right?
Yeah. There's definitely lots of options available.
Yeah, absolutely. Tons of options. So yeah.
All right,
okay.
Perry.
All right. Well, we thank you both for everybody for listening to our diatribe, our 2-hour podcast, we'll call it.
We hope it wasn't too long. And
all right, from me, thank you, everybody.
Yeah. And guys, it's the weekend, so enjoy the rest of your weekend. And as I always say, bye for now.